Brad Williams. Frugal Finance, credit cards. I've been saying this repeatedly. When you're looking for a credit card, when you're shopping, I've always mentioned look at credit unions. Look at smaller banks. Well, here from the CFPB, a great resource, research on or a study provided by this group about credit card data, small issuers offer lower rates. What they've done is they went out and they looked at over 150 issuers of all sizes across the country as required by the law. Now keep in mind there's over 14,000 different credit cards out there in the US. 150 is probably a good sample size. Here is what the CFPB is saying. During the first half of 2023, small banks and credit unions tend to offer cheaper interest rates than the largest 25 credit card companies across all credit score tiers. No surprise there. The difference in reported purchase annual percentage rate between the largest and small issuers translated to average savings of $400 to $500 a year for a consumer with an average balance of $5,000 using a small bank or credit union cards. Nearly half of the largest credit card issuers reported offering cards with a maximum purchase APR over 30%. Products offered by large issuers were 3 times as likely to include an annual fee than those at small institutions. The average size of annual fees for the largest issuers was approximately 70% higher than at small institutions. Shameful. Shameful on the part of the large credit card issuers. Shameful on people for not shopping. The CFPB's latest survey included data on 643 credit cards from 156 issuers, 84 banks, 72 credit unions offered from January through June of 2023. 430 cards were available nationally, while the remaining were only offered regionally or in a single state. The CFPB collected information on general purpose credit cards with the largest 25 credit card issuers in the US, as well as representative samples of products from small and medium-sized banks and credit unions across the country. The information included data on purchase APR, which is the interest rate issuers charge on purchases when consumers carry a balance. Small issuers, median APRs are significantly lower than the largest institutional rates. During the survey period, the reported purchase APR between the largest and smallest issuers was between 8 to 10 percentage points. Wow. Even though some of the largest issuers market credit cards to subprime borrowers, consumers in the highest credit score tier also saw an 8% difference on interest between large and small institutions. Small issuers include federal credit unions, which have a statutory interest rate cap currently set at 18%. However, excluding credit unions, small bank issuers also tended to price APRs lower than large bank issuers. For a consumer with an average balance of $5,000, this APR difference would mean $400 to $500 in savings a year for using a credit card issued by a small bank or credit union as opposed to the largest issuer. Shocking, isn't it? Shocking. Simply go out, do a little bit of shopping, and you're going to save a lot of money. You're going to save a lot more if you get this $5,000 down to zero. Then you wouldn't have to worry about this, but you should consider talking to the credit unions. Now, there are generally some requirements for credit unions, but they're pretty loosey-goosey. I mean, that is, they usually have criteria, and you have to belong to this group or that group, or most likely, most people probably will be approved through a credit union, even those with bad credit score. Now here is the shocking fact. Look at this. Institutional size, large, small, poor credit, scores less than 619, nearly 29% versus 21%. Good credit, and this is still shocking, 28%, 18%. Great credit scores, 23 to 15. Yep. I have a lot of nasty words for these large credit card companies, but this is a G-rated. This is why I report this stuff, because it just is frustrating as all heck. Credit card issuers pricing over 30% indicates an institution not in the top 25. Look at this. First Financial Bank, Ally Bank, Bank of Puerto Rico, Capital One. These guys are crooks, period. Citibank, they're just as bad. Comenity, Commerce Bank, First National Bank of Omaha, First Bank, Puerto Rico, Merrick Bank, Synchrony Financial. Now, isn't it amazing that these groups, you're going to see over and over again why they're charging 30%. They've got to pay for their marketing. They have to figure out a way to scam you. So they bombard, let's see, every sports stadium in the world out there, every possible avenue that they can brand their particular company name. How often do you see Citibank at either a baseball or football game, or tennis? TD Bank or Bank of Missouri, USAA. In general, large institutions were more likely to charge annual fees than small institutions and credit unions, with 20% of large issuer card products charging an annual fee compared to just 9.5% of small firms. Large institutions' annual fees were also higher than at smaller fees in credit unions, averaging 157 as opposed to 94. Well, first and foremost, you should never, ever pay a fee. Right there. That's going to bump up your APR significantly, even though it's not computed. You need to find a comparison. There should be absolutely no reason for these groups to be charging a fee. Lack of competition likely contributes to higher rates at the largest credit card companies. CFPB research has found high levels of concentration and evidence of practices that imply anti-competitive behavior in the consumer credit card company. Well, there's no shock there. As we noted in 2023, the top 30 credit card companies represent about 95% of credit card debt. Ouch. And the top 10 dominate the marketplace. That's interesting. I didn't know that. We discovered and reported that about half of the largest credit card companies simultaneously stopped sending payment information to the credit bureaus, making it harder for consumers to find better deals. Companies further distort the credit card shopping experience by providing incentives to comparison websites that might promote more expensive products over cheaper alternatives. Stay away from the hype of the internet, social media. People that are pushing these credit cards are getting a huge commission. We also have concerns about the way high interest rate products drive consumers into persistent debt. These concerning tactics may limit price competition, prop up higher rates for consumer carrying a balance, and have the potential for harm. While products offered by smaller issuers may not show up when consumers look for a new card online or in their mailbox, consumers often find relatively cheaper credit products at smaller banks or their credit union. You're going to have to do a little bit of legwork, turn over a few rocks. Locally, look at 3 or 4 credit unions. Generally, do that just going to their website and seeing what their credit card rates are. Doesn't take any time, maybe 5 minutes. Most smaller credit card issuers are not required to participate in our survey. However, they can voluntarily contribute data to allow consumers to compare their products, while those offered by larger institutions. Okay, the CFPB, the consumer credit card market, I will report on this. This lengthy, it's 18 pages. I'll delve into that. I'll delve into all of this stuff here, and I will report the damage that these credit card companies do to consumers. Bottom line, it's pretty simple. Call up a couple credit card companies, call up a couple of credit unions, smaller banks, see what they have to offer. See if you can transfer over without too much brain damage. See if they do this without an annual fee. Do your shopping. Turn off the damn television, turn off social media, do a little bit of legwork. You'll discover that this $500 a year, if you park that into a mutual fund, an ETF, over 40 years, just that $500 a year is going to grow probably to $45,000, maybe more. No, more than that. But you get the idea here. Let me know. Give me your tips. Give me your feedback. Let me know what works for you. Give me some honest feedback, whether you're working with a credit union that is offering not just a promotional deal, but has a long-term history of favorable rates, minimal fees, and maybe some promotional deal. Maybe they have a 2% deal at an 18% interest rate, as opposed to a 30% interest rate at a 1% promo. You get the idea here. Give me some feedback. Brad Williams, Frugal Finance. Hope that helped. Thanks for watching. See you soon.